Welcome back to our channel, where we explore together the hottest developments in the global financial markets. And today, we are going to talk about a truly shocking event, a historic milestone that has just been set. Gold, the most precious metal, has officially broken all records, soaring past an unimaginable threshold and causing the entire world to hold its breath. Right now, take a look at this number, $5,000 per ounce. Yes, you heard that right. On January 26, 2026, the global gold price officially surpassed the $5,000 mark. And in today's trading session, at the time I am recording this video, gold even reached an unprecedented peak. Prices touched the historic range of $5,100 to $5,126 per ounce. This is the first time in history that we have witnessed gold conquering such a new height. A majestic peak that previously existed only in the boldest forecasts. But what is really driving the value of this precious metal right now? Today, we will dive deep into one extremely important factor: geopolitics. It can be said that this is the main force behind the powerful waves currently moving the gold market. Let's start by looking at the bigger picture. Geopolitical tensions around the world are escalating day by day. We are not only talking about prolonged trade disputes between major economic powers. We are also referring to latent strategic risks across many regions. Do you remember the discussions about purchasing Greenland? Or the simmering conflicts that occasionally erupt in different parts of the world? All of these events, whether near or far, contribute to an atmosphere of uncertainty and anxiety. When the future becomes unpredictable, investors worldwide begin searching for a safe haven for their assets. And for thousands of years, gold has always been the top choice. Gold does not depend on the policies of any government. It is not eroded by inflation like fiat currencies, and its value is recognized globally. Therefore, when geopolitical risks rise, demand for gold naturally increases. Capital flows strongly into gold, not for short-term speculation. Instead, it is meant to protect asset value against potential storms ahead. To better illustrate this relationship, let's look at a specific example. On January 26th, gold recorded a very strong bullish trading session. Many analysts and reputable market sources pointed out that the direct cause of this rally was defensive capital inflows. Investors, faced with global risks showing no signs of easing, poured money into gold simultaneously. They were not buying because they expected gold to rise a few more percent tomorrow. They were buying because of fear about what might happen next week or next month. This behavior is similar to buying insurance. You don't buy insurance because you want an accident to happen. You buy it to protect yourself if something bad does occur. Likewise, major investors, hedge funds, and even central banks are accumulating gold as a shield. They look at global hotspots, fragile trade negotiations, and recognize that holding gold is a prudent strategy. We need to understand that the modern gold market is no longer driven solely by jewelry or industrial demand. A significant portion of the market is driven by investor psychology. And this psychology is deeply influenced by geopolitical events. Every time there is news of a new conflict, a tougher foreign policy stance, or a sudden power shift, gold reacts immediately. So, what does this mean for us as individual investors? First, it gives us a deeper perspective on the market. Instead of focusing only on technical charts, we must also follow global news. Events in distant places can directly affect your investment portfolio. Second, it reaffirms gold's role as a diversification and risk hedging tool. In a balanced portfolio, allocating a certain portion to gold can help reduce losses when other assets decline due to political instability. In summary, geopolitical tensions are not just newspaper headlines. They are an extremely powerful force shaping capital flows into the gold market. From trade wars and territorial disputes to shifts in global power, all reinforce gold's position as the ultimate safe haven. The surge of defensive capital into gold during volatile periods is clear evidence of growing investor caution in an uncertain world. Now let's turn our attention to the U.S. Federal Reserve, commonly known as the Fed. This week, all eyes are once again on Washington, where the Federal Open Market Committee meeting will take place. Most notably, the speech by Fed Chairman Jerome Powell after the meeting is the most anticipated event. Why is this meeting so important? Simply because every Fed decision on monetary policy, especially interest rates, has far-reaching global impacts. It affects not only the US dollar and stock markets, it also influences key commodities such as gold, oil, and even the cryptocurrency market. At this meeting, scheduled for January 26th, the Fed is widely expected to leave interest rates unchanged. However, what investors truly care about is not immediate action. They are focused on the signals and messages hidden in Powell's speech. They are trying to decode the future policy path of the Fed. Will the Fed continue tightening to fight inflation? Or will it begin to hint at easing in the medium term? This is the key question. The market is betting that sooner or later, the Fed will have to adopt a more accommodative stance. Maintaining high interest rates for too long puts heavy pressure on economic growth. When the economy shows signs of slowing, the Fed will be forced to act. And when easing is discussed, gold inevitably enters the conversation. As a non-yielding asset, gold usually faces pressure when interest rates rise. When rates are high, deposits and government bonds become more attractive. The opportunity cost of holding gold increases. Conversely, when interest rate cuts are expected, the situation reverses. Lower rates reduce the appeal of yield-bearing assets. Gold becomes more attractive as a safe haven and inflation hedge. That is why the gold market is extremely sensitive to Fed signals. A dovish tone from Chairman Powell could immediately push gold prices higher. A hawkish stance, however, could trigger a correction. Beyond interest rates, Fed policy also affects the US dollar. When the Fed eases, the dollar typically weakens. Since gold is priced in dollars, a weaker dollar makes gold cheaper for foreign investors. This boosts demand and pushes prices higher. This creates a double effect. Low rates and a weak dollar both strongly support gold prices. So, what should we do in this environment? First and foremost, stay calm and stay informed. Markets around Fed meetings are often volatile and unpredictable. Making hasty decisions based on rumors can lead to unnecessary risks. Listen carefully to Powell's speech. Pay attention to how he describes inflation, the labor market, and economic growth. Small wording changes can reveal important policy clues. Diversification remains a wise strategy. Never put all your eggs in one basket. Even if you are bullish on gold, spreading assets across stocks, real estate, or cash helps manage risk. For long-term investors, short-term volatility around Fed meetings may not matter much. The broader monetary policy cycle of major central banks is what truly matters. If you believe we are entering an era of high inflation and negative real rates, strategic long-term gold accumulation is worth considering. In conclusion, this week's Fed meeting is a critical event that no investor should ignore. It influences interest rates, the US dollar, gold prices, and many other asset classes. Let's also look at the relationship between a weak US dollar and global capital flows, especially their impact on gold. When the US dollar weakens, gold prices often rise. This happens because gold becomes cheaper for investors holding other currencies. A weaker dollar also reflects declining confidence in the US economy. During such times, investors and central banks seek safe havens. Gold, with its 1,000-year history as a store of value, becomes the top choice. Additionally, the global trend of de-dollarization is accelerating. Many central banks are increasing gold reserves to diversify away from the dollar. A weaker dollar strengthens this incentive and supports long-term gold demand. In summary, the sustained weakness of the US dollar creates a perfect environment for gold's surge. It lowers the cost of gold for international investors and redirects massive capital flows into safe haven assets. Gold prices on January 26, 2026 set a new record above 5,000 USD per ounce. This reflects strong safe haven demand and expectations of looser Fed policy. Geopolitical risks and accommodative monetary policy remain the main drivers of the gold market. This analysis represents my personal opinion and is for reference only. It is not investment advice. Please do your own research before making any decisions. Remember, no one else is responsible for your investment choices. Thank you for taking the time to watch. Don't forget to like, share, and subscribe to the channel so you don't miss any important updates. Goodbye, and see you again in the next video.